And welcome to the latest in our investing tips series of videos. And before I get started, I'd just like to remind you, if you sign up on behindthebalancesheet.com, you'll get access to our free newsletter and lots of free training materials. And if you're interested in taking this a bit further, I really recommend you have a look at some of our investing courses for private investors. Behindthebalancesheet.com. Enough of the adverts, let's get on with investing tips number 12, and this is fifth in our series of looking at moats. And if you recall, we talked about economic moats, a term coined by Warren Buffett, which is a subjective way of identifying high quality companies. And a moat is a structural impediment which obstructs your competitors from entering your company's markets and reducing its returns on capital. And the effect of an effective moat is a sustainable high return on invested capital. And in the first four of these series, we looked at economies of scale, we looked at network effects, we looked at intellectual property and brands, and we looked at customer loyalty. If you read the textbooks, customer captivity is defined slightly differently from customer loyalty. In fact, as I'll show you, the two things are really close together. And customer captivity, I'm not convinced, is as strong a moat today as it used to be. Let me explain why. Cola. Why is cola a moat? Why is it customer captivity? The taste, obviously, if you like Coca-Cola or you like Pepsi, you'll find the taste of the other product really quite different. But is it that different? You know that Pepsi did that series of adverts with a taste test, and if you take just a very small sip of cola, a Pepsi will be sweeter than a Coke and taste better. But as you drink more and more of it, the Pepsi is much sweeter, much more cloying, and therefore many people prefer the taste of Coca-Cola. But it's not that big a deal. Obviously, if you're in a restaurant and they only serve Coke or they only serve Pepsi, if you like drinking Coca-Cola, you probably will just take whatever they offer you. As I saw last week when I was in Seoul in South Korea, where there was an American gentleman ordered a Diet Coke for breakfast, which I found quite extraordinary. So please don't take offense. Each to his own. If you want to have Coca-Cola at breakfast time, fine, not very healthy. But the point here is that yes, you will stay loyal to that brand and you will rarely deviate from it because the tastes are sufficiently different that you're captured as a customer. Cigarettes. Now, again, the taste is very different. And so if you're used to smoking Marlboro, it's highly unlikely that you'll smoke Dunhill because the tastes are very different. But there's an additional element here, is a branding element, because the image of a Marlboro smoker is really quite different from the image of a Dunhill smoker. Here's a Marlboro smoker, cowboy, and here's a Dunhill smoker, James Bond. Very different, obviously. And beer. Beer is quite an interesting one because beer is one where customer captivity and customer loyalty are much less solid. So yes, you will be loyal to your brand, but it depends on the occasion. Because if you go out for a Thai meal, you're much more likely to drink a Tiger beer. Whereas if you're an American going for a barbecue, you're much more likely to drink Bud or whatever you normally drink. So with beer, there is an element of customer loyalty, but it only stretches so far. It's much less resilient. And it's my hypothesis that this customer captivity is much less resilient than it used to be. Obviously, it's much more resilient in the case of cigarettes, but even there, do you remember Philip Morris, now renamed Altria, paid, I think it was $35 billion for a stake in Juul. And when I did my podcast with John Armitage, the not so well known but incredibly successful 28 billion AUM hedge fund manager, he pointed out that no industry was immune from disruption. because he said these seasoned veterans at Philip Morris were prepared to pay up to protect themselves against the disruption of Joe. And this was a very telling deal, because this was a huge amount of money, and this was a product which one assumed had an impenetrable moat. So my point is that customer captivity moats aren't what they used to be. So yes, they're useful, and in the case of cola and cigarettes, they're incredibly helpful, less so in the case of beer, but beware the risk of disruption. So in the pecking order, customer captivity would be lower than it used to be. Thanks for watching. If you're enjoying these videos, please don't forget to subscribe on the YouTube channel, and also make sure you visit our website and sign up for our newsletter and free training materials. Thanks for watching.